Attendees are in listen-only mode.
Welcome to our web seminar today, How Logistics Companies Use Trade Credit Insurance for Growth and Receivables Risk Mitigation. Before we begin, just a little bit about your technology. Your lines have been muted for the duration of the webinar. You can ask questions at any time through the question box. Could we advance to the next slide, please? It's important to note that you can ask these questions. We'll queue up as many as possible during that time, and we will try to address as many questions as possible for the duration of the webinar. Now, with that, allow me to introduce our speaker. And we apologize for 1 second as our speaker gets the slide up on the screen. Our speaker today and our subject matter expert is David Clark. He's been helping companies of all sizes safeguard and grow their business, leveraging trade credit insurance. He has a decade of experience. His area of expertise includes small, local, private companies to large Fortune 500 corporations, targeting those companies with large international exposures, domestic trade concerns involved with open term trade policies. Industry experience is focused on manufacturing, wholesale distribution, logistics, agribusiness, energy, and metals. With that, let's advance to the next slide, and the floor is yours.
Thank you, Alan. I appreciate it. I want to thank all of the attendees as well. The goal here today is to give you a brief 10,000-foot view of trade credit insurance and how it can help your business not only mitigate the risk of trade, but also expand your sales, leverage your financing, and offer you information that you might not be privy to. So what we're going to do right away is we're going to identify what exactly is trade credit insurance and why is it important. When you think about trade credit insurance, it is specifically directed towards your accounts receivable. Your accounts receivable in a typical company is going to be one of your largest assets, and typically one of the only assets that are not insured. One of the questions that I often get asked is, what amount of loss would seriously impact the company's profit? The idea here is your receivable is the most likely asset to have a loss. Companies in today's market are not paying their bills on time. They are being pinched by their credit and their banks. And there are a lot of other issues that are out there that are looking at companies looking to mitigate these issues, and trade credit insurance is an obvious solution. So when you think about your accounts receivable, for a typical trucking company, it's going to represent 70 to 90% of a company's assets. As I mentioned, it's most vulnerable to unexpected losses. And as you're going to see in this slide, the identification of how trade credit insurance operates within the delivery, the invoicing, the orders, and then ultimately the payment of those invoices. Trade credit insurance is going to offer you leverage throughout that process. It provides cash flow for the business, and typically you're going to find that without trade credit insurance, you're going to be in a non-competitive advantage. This is a great slide. This slide demonstrates those companies that have recently filed for bankruptcy. I often get asked, well, why do I need trade credit insurance? Trade credit insurance is only going to help me with a couple accounts. At the end of the day, these are major corporations, some big, some smaller, but they have all filed for bankruptcy, which means they have not paid their bills, which means if you're not dealing with them directly, you might be dealing with one of their subsidiaries or a company that's related to one of these companies. Each one of these companies has a story to tell. Each one filed for different reasons. But at the end of the day, this slide tells you that nobody is immune. Everybody has the opportunity for a loss. So what is trade credit insurance? Trade credit insurance is going to offer you risk mitigation against catastrophic loss prevention. It's going to help you leverage your financing relationship. It's going to help you expand your sales and improve financial monitoring and operational efficiency. Because what we're doing is we're insuring that asset. If your customer doesn't pay you on time, the credit insurance company will pay you. So the first and foremost reason somebody signs up for the product is risk mitigation, catastrophic loss prevention, and cash flow protection. At the end of the day, somebody doesn't pay you, you want to know that you're going to get paid. That's paramount. I would say most opportunities are going to start with that reason. You want to be able to reduce concentration levels. You want to be able to improve your balance sheets. It's an accounting product in terms of helping the CFO manage that side of his business much easier. But it's also for the shareholders, knowing that they're going to be able to budget and forecast accordingly, and that it's not going to affect their profit at the end of the day. A loss is only, the loss that a company will occur can devastate some companies. Even a $50,000 loss can change the direction of a company on whether they hire people. They can change the direction of whether or not they are in a position to expand other markets. At the end of the day, risk mitigation is the first and foremost reason. Financing. When companies in today's world look at trade credit insurance, they're looking at how they can leverage a value and a return on investment. A lot of times banks are going to be lending off of those receivables, and what we find is in the trucking community, most companies are going to have trade credit insurance as a leverage in your traditional bank line. This is not factoring. We're not buying your receivables. Again, we're insuring the receivables. So the bank will look more strongly upon offering you higher availability and often lowering your terms. I realize that some of the attendees might not have foreign receivables, but if you did have any receivables that were going to Mexico or Canada, your bank may require you to have credit insurance to be able to cover those receivables within your collateral base. And it also eliminates the need for letters of credit, and it eliminates the need for personal guarantees, which often are used with the banking relationship. The sales expansion component to what we do is very important. With our product, you're able to increase your sales by offering your customer better terms. If you have net 30-day terms, you have a customer that might want 45 or 60-day terms. With credit insurance, typically you can offer those terms without risk. You may have a customer that you're limiting your exposure to on a credit limit basis. For instance, say you have a $100,000 credit limit. With credit insurance, you might be able to offer $200,000, $300,000. Large credit limits are not immune to our world. And so you will be in a position to offer better terms to those customers, thus increasing your sales significantly. Improving financial monitoring and operational efficiency. I think this is important because a lot of the companies that come to us, they are not typically looking at the same type of information that we're able to become privy to. We, as a credit insurer, are able to receive not only the public third-party information like a DMB or an Equifax type report, but we're also able to get banking relationship information. We're able to get trade information. We're also able to get private financial information in some cases. And so from an analysis perspective, we're able to combine all of that information and offer a detailed analysis of the buyer's credit purchasing ability. So what are some of the quick reasons why a company is going to come to us for credit insurance? Sales concentration is a big one. If you have an account that has a significant amount of concentration, you want to make sure that you're going to be covered, because if that one company were to not pay you, that could be significant. It could be devastating for a company, and we see that very often. If a company is in a rapid sales growth, they need information quickly. They need to be able to offer terms to those customers in a productive manner. They're going to be able to do that with credit insurance. Lots of times we get the call that they just were involved in a bankruptcy, or if they had a company that just slow paid them, so they're not able to fund their bank. Something has just occurred, or if they have a recent history of a significant amount of bad debt. Typically, if a company is going to have over 1% of bad debt history, they're going to be looking for other avenues to try to mitigate that risk. If you have a special order shipment, you have a unique opportunity that is going to offer you a specific risk that is outside of your box. Credit insurance can offer you protection in that scenario. I mentioned this earlier, longer terms of sale, you have a customer that is asking you to increase your terms. We're going to be in a position that we're going to be able to offer that protection for you. And then again, when you're financing your receivables, your bank may come to you and not only require it, but strongly encourage you to have receivables in order to receive the financing relationship that you're accustomed to. In there with, when you talk about specifically trucking companies, a lot of times you have thin margins. If you're dealing in less than 3% margins, or even I would say 5% margins, a loss can significantly impact your bottom line. So you want to make sure that you're covered to avoid those even small losses. And then we deal with a lot of companies that just have a low tolerance for risk. They are going to want to make sure that they have a very tight credit department. They're going to be looking at ways to protect their business in just a general sense. Those types of companies are going to gravitate towards credit insurance very easily. And then also, if you're a small to medium-sized company, you might not have a seasoned credit department. Your credit department may not be able to receive access to information. You may have a lot of tension between a credit department and a sales department. Obviously, with trade credit insurance, we're going to be able to alleviate that tension and make it easier for you to be able to make decisions. This is a great example of exactly what I'm talking about with the profit margins. When you have a company in your, let's say, for example, $50 million company, and you're looking at a typical 3% profit margin for a trucking side, you're going to look at a premium rate somewhere in the range of around 15 basis points, depending on the risk of your customers and the scale of the policy. On average, you can expect to pay right around $65,000 for a full portfolio policy. And by that, I mean we're covering all of your receivables. So if you had a $50,000 shipment, you can expect a $1,500 profit. Cost to insure that transaction, if you take that rate of premium of 15 basis points for $50,000, is going to be $75. Obviously, if you lose $50,000 because that customer doesn't pay you, on average, it's going to take you around $1.6 million in new revenue to recover from that loss. That's a significant example. We deal with this on a daily basis. Companies that are looking at these types of exposures, are not going to necessarily focus on that $50,000 exposure. A company doing $50 million in sales, they're typically going to have a number of accounts that would be significantly over that amount, 100,000, 500,000, even maybe in a $1 million exposure at some point. They may not be focused on even that small account, which can obviously affect their bottom line significantly. I'm not going to read this case study, but I think it's important as an example of how trade credit insurance can affect a specific trade or a specific trucking company. At the end of the day, this company was able to not only survive but thrive with credit insurance. Let's give you a quick second to scan through that. Bottom line here is, with trade credit insurance, we became an integral part of not only their credit, but also their sales expansion component. And then one final case study. It's a family-owned trucking company. It's a small company. And again, we became an extension of their credit department, became really a strategic partner with their sales goals, and what they wanted to do moving forward.
Thank you very much. We
Alan?
really appreciate, thank you. We appreciate the presentation today. Several questions have come in. While we're doing that, we'll launch a poll if people want to have additional information on this topic, if they want to suggest a new topic, if they want to meet with Cline Wood about this or some other coverage needs that they might have. You can fill in this poll. It's confidential. We will not publish the results to everyone. And while that poll is open for a couple of moments, we will have the first question. Several questions have come in, sir. Relating to this, do we need to insure every account or all of our accounts, or can we insure a specific buyer?
That's a great question. At the end of the day, there are very flexible policies available for the companies that will be looking into this. In the past, it used to be you would have to insure all of your receivables, or maybe just one single buyer that was, for example, like a Walmart, which frankly was not adding much value to the policy. In today's world, though, it is much different. You now can insure even marginal accounts on a single account basis, and ultimately you can insure segments of your business. For example, maybe just your top accounts, or maybe if it's a specific division within your company you want to insure. You are able to obviously lower your premium by identifying those companies, but also add value and your return on investment by isolating those high-risk areas. That's a great question.
Very good. And we're going to close the poll in a moment. If anyone else wishes to vote or to ask for additional information, please do so. The next question that came in, and there were many variations of this, it could be difficult to answer, but what do these policies typically cost?
Another good question. You know, at the end of the day, it's really going to be driven off of the business's accounts receivable risk, their profile, how much are they going to be insuring, what type of factors are going to be involved in the transaction. Is there going to be a high-risk environment for the insurer to be involved in? But at the end of the day, typically you're going to see a company that's going to have a policy under 0.25% of those sales. That's a good rule of thumb. And I think it's important, too, that when you think about the cost of the policy, it typically is going to be less than what a company will have either in a bad debt reserve or in a typical loss history. You know, I showed in a slide earlier that, you know, if a company is over 1% in bad debt reserve, they're going to come to us. We see companies that are coming to us with 3 to 5% bad debt, and obviously paying us less than 0.25% is going to significantly impact their bottom line.
There were also several questions relating to how much information is needed, how much detail, how onerous is the process to provide information.
Another good question. I think that at the end of the day, really the information that's needed is an aging report and an idea of how they operate within a business. You're going to find that there's an application. The application is just a couple pages that identifies what their business model is, identifies if there's any specific needs for the company. And the aging report is to give an idea of where they are at in a snapshot view. The process is really very simple. You would go through your broker. The broker would be able to facilitate the discussion. Obviously, using us as a resource, we would be able to facilitate offering not only the quote, but offering options that they can look at as well. So it is a consultative process from there.
And there were several questions about your venue, where you're located, where you service.
I specifically operate within the Midwest. I'm based out of Kansas City, but I can operate throughout the nation. If there is an opportunity, whether it's in Florida, California, or New York, I can be a resource for them, and then ultimately work with Cline Wood as the broker to help facilitate that discussion.
And that's an excellent segue to end the webinar today. Information, questions can be routed to university@clinewood.com. That information is on your screen right now. Once again, university@clinewood.com. You can call them at 913-451-3900 or go to their website, www.clinewood.com. We would very much like to thank our subject matter expert today, David Clark. Thank you for being our presenter. And we encourage everyone to look for future Cline Wood webinars coming each and every month on a variety of important business topics. With that, this web seminar is now ending. We thank you. You all have a great day.
Thank you, Alan.